some of the interesting things that may impact the Australian economy is if Donald Trump does get elected, you're potentially looking at China and tariffs on China. So you're talking about a potentially 60% tariff on Chinese imports into the US.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again and back on the 360 Money Matters podcast.
Andrew, I say this week in, week out, but it is literally the favourite time of week for us.
I know. You get to listen and speak to me for, an uninterrupted half an hour. How could you not love it?
This is true. Well, on that note, Andrew, what are we talking to everybody about today?
So today we're back with our monthly market wrap. So going to do the rounds and see what's been happening in the investment markets for the last month or so.
Fantastic. Let's get into it and looking forward to it. So starting with the American market, so the Standard & Poor's 500, always a good one to open with. So we're seeing that the S&P 500 is up 5.18% for the month.
It's massive.
It's massive, all right. There's it's not too often that we jump on here and say that that's the case, but that's a sensational result.
Yeah. And look, I guess a part of that is the East Coast strikes. So a bit of a resolution there, or at least a temporary resolution, which does mean that the markets were quite positive off the back of that news, because that could have potentially had some major shipping issues, not just in America, but across the remainder of the world. So for those that didn't hear about it, the East Coast workers, so
this is the dock workers?
Yeah, dock workers, 36 ports. They were threatening to strike, so they were wanting a pay rise. I think initially they were wanting a 76% pay rise because the West Coast dock workers were earning something like 40% more. There's been a temporary resolution on that, so they've paused any strikes until the 15th of Jan next year, and the temporary agreement is a 62% wage hike over the next 6 years. So it's a pretty hefty pay increase for those dock workers, but I guess probably brings them in line to what the rest of the country's earning.
Are we just dropping some really big numbers today? 62% over the next 6 years.
Massive.
And originally asking for a 77% pay increase.
Yeah.
76. That is insane. Alrighty. So
from a market perspective, I mean, really welcome news that that's been resolved, because that was some potentially some massive disruption across shipping, which we also saw what happened to inflation with everything that was happening around the world previously. So very welcome news.
Yep. Declining price of oil has been positive for the market as well too, which is really positive. And then taking the lead from the US. So a couple of weeks ago, the US dropped their rates faster than expected. They actually moved 50 basis points down. It was expected that they were going to move 25, but they actually gave it a little bit more of a push and moved 50 basis points, which is great.
Yeah. So I think some welcome news, not necessarily for borrowers over there. I think they've got a little bit of a different market when it comes to home loans, where it impacts new borrowers, not existing mortgage holders, just because most of their home loans are sitting on a 10-year fixed or sometimes even longer. And so hopefully what that'll mean in the US is maybe a bit more transaction on the real estate side of things. But in looking at some even more positive news in the US, GDP came back better than expected. So came back at 3%. Expectation was for that to be at 2.9%. So growth in the US economy, and jobless claims was also a fair bit lower than what expected. I think about 20,000 jobs lower than what was expected. So some fairly positive news out of the US market.
So looking through that data, I mean, essentially it looks like the Fed are making the right decisions from a monetary policy perspective. You're looking at unemployment or jobless claims being lower than expected, which means less people are unemployed. GDP is higher than expected. It sounds like the way that they're navigating through this is really positive, and the decisions that they're making are having the desired effect.
Yeah, I mean, look, the data out of the US for last month, I mean, yeah, you'd be hard pressed to find better data in a monthly basis. So it's really positive across, all aspects, which is why you're seeing the market responding to it, and we're doing, they're getting a 5% growth in the space of a month.
Yeah, and sort of pivoting onto sort of an extension of that, Andrew, we're seeing the household savings rate increase as well too, which is great. But the amount that we've seen it increase by has been huge as well. So the household savings rate was originally 3.3%. Now it's moved up to 5.2, which is a huge jump. I mean, it only sounds like 1.9 points, 1.9%, but it's actually a massive amount.
Yeah, well, 1.9 on 3.3%. Like, you're talking about pretty much almost doubling, which is it's some really welcome news. And I think that when inflation has been so high and savings has been so difficult to come by, to see that rate of savings increasing at the rate that it has been is really positive news.
Talking about positive news, 5th of November, we're talking about the US election, not the Melbourne Cup sort of race week. We're not talking about the race that stops a nation, although I think the 5th, it is actually Melbourne Cup Day, but no, so we're talking about the US election.
And that'll stop the world, not the nation.
Well, let's talk about that and the impact that we think that that's going to have on markets, because that's going to be such a huge, huge thing that happens. Obviously, we've got Donald Trump, who used to be president, and then you've got the vice president going at it as well too. So, what do we expect out of the back of that?
Yeah, I mean, look, it's still looking like it's going to be a very tight race. So there isn't really, I mean, the market's not really pricing in either candidate at this stage, because you ultimately don't know where it's ultimately going to land. I think that, some of the interesting things that may impact the Australian economy is, if Donald Trump does get elected, you're potentially looking at China and tariffs on China. So you're talking about a potentially 60% tariff on Chinese imports into the US. So what that does, and we'll talk a little bit about China because there's been some more positive news on the market side of things in the last month or so. But what impact that has on China, on their manufacturing and on their economy returning to what it had been pre-COVID is going to be very interesting, whether they decide to ramp up production and supply around the world, or whether that impacts their production and means a Chinese slowdown is, going to be very, very interesting. And I think, it's going to be positive for most economists out there once the election is done and we just have a direction and we know where things are likely to head.
And it was interesting enough with Kamala Harris the other day on an interview, they asked her what would she do different than Joe Biden. And basically she said,
nothing,
absolutely nothing. And I think that was it went down like a lead balloon, because it's basically, we're going to get Joe Biden Mark II essentially. And I don't think that did too well for her campaign. So we'll wait and see. But look, on the news of China, I mean, they've been going through a really interesting time in terms of trying to stimulate their economy, their property markets in the doldrums, but the CCP are trying to do a fair bit to bring that back to life again. Yep. And if we see that they're successful with that, I mean, the prosperity that we're seeing at the moment, I expect will continue. But Andrew, you've got some numbers here. Let's run through some numbers, some stats through what's going on in the Chinese economy.
Yeah, just to throw it out there. I mean, look, the major thing is that they're really trying to stimulate that economy. That's the general consensus. And this is the biggest stimulus that has been announced in China since COVID. I think everyone was probably expecting this about, 9 months ago. So a lot of people will say that this is long overdue. But they're talking about, a 0.5% cut to the reserve requirements for banks. So talking about additional lending. Mm-hmm. They're talking about a 10% cut in the down payment required for second mortgages, so bringing that down to 15%. They're talking about a 0.5% cut in existing mortgage rates, a $142 billion US capital injection, more than $100 billion in funding from the People's Bank Republic of China to brokers, funds, and insurers to purchase equities. So ultimately, what this really is looking like is the Chinese government is really trying to step in and stimulate their economy. And this is the first time that we've seen it since post-COVID days. So it's some really welcome news for China in terms of what's likely to happen there. And which we'll touch on in a second, some positive news for the Australian economy, particularly the materials.
So just on that Chinese story, so two things that I took out of that. Obviously, the government are trying to stimulate the economy by doing really two things. One, adding liquidity into the market, and two, making it easier for people to borrow money, or the hurdles that they need to jump through in order to get into the property market. They're actually reducing those barriers to entry.
Yeah, exactly right. So they're trying to stimulate their property sector. They're trying to stimulate funding into equities and shares. So they're really going on all fronts to stimulate and put some growth back into their economy, which has been needed. And I think that, what's going to be really interesting off the back of this is if we do see tariffs on China with the Trump election, how that plays into all of it, and whether that neutralizes a lot of the work that the Chinese government is putting into stimulating some growth.
Andrew, let's look closer to home. Australian economy. The ASX 200 for the month was up 2.94%. So really good result for us locally as well. So that's something to be highlighted and celebrated.
It's massive. It's massive growth, but when you compare that to the US growth, it just it seems like it's been dwarfed a little bit. But no, look, some really, really strong growth in the Australian economy or in the Australian share market. Interesting part of that is if you isolate that out and look at just the resources part of the market. So ASX 300 materials, that was up 9% in 1 week. So off the back of the Chinese stimulus news, the resources market or the materials in Australia went absolutely gangbusters. Yeah.
Our favourite, public figure, I guess, Michelle Levy, the governor of the Reserve Bank. So she's obviously been under continued pressure to decrease the rates. As we currently know, the rhetoric is that we still don't know what we're going to do. It could go up, it could go down, it could go sideways. Who knows? They're still sitting at 4.35%, and that's despite headline inflation falling to 2.7%. So if we look at that, that is actually within the target range of what they set. But at the moment, there's still some caginess around the wording, and I actually think that they're being overly conservative, because going back to the previous Reserve Bank governor, we won't mention names here, but where he mentioned that rates won't change until 2024. Yeah. So I think that they're just worried, which is really silly because their job is to give us guidance. I think they're worried about doing that and getting it wrong and then copying the backlash that he received previously.
Yeah, well, a couple of interesting things within that. Michelle Levy, she mentioned that even though headline inflation had fallen to within that target range, so between that 2 to 3%, she didn't want to decrease interest rates because a lot of the reduction in the inflation was as a result of the temporary cost of living relief that was given by the government. Mm-hmm. And so because that's only going to last for 12 months, she basically is disregarding any impact that that's having on inflation because it's something that's temporary rather than an actual fix, which I understand to some degree, but ultimately, the fiscal policy and the monetary policy are both working to bring down inflation, and disregarding one aspect of it makes a bit of sense in one regard, but doesn't make much sense in the other. The other really interesting, which I think is extremely unlikely to happen, but there was some commentary from the Greens in the last week or two, and they were talking about putting in some government measures where the government can step in and use their powers to decrease interest rates without needing to do so on the Reserve Bank side of things. So there was a little bit of chatter around that. Now, I think that's extremely unlikely, and to be honest, I don't think that that's going to happen. But just goes to show the pressure that's on Michelle Levy just to drop rates, and how it's, you got to admire the fact that she's standing strong. And it's not just her; it's obviously the entire RBA board. But they're staying resolute with interest rate reductions.
So the next Reserve Bank meeting is on what are we talking? November, don't know the exact date, but it is in November.
Yep. I lose track these days because it's no longer the first Tuesday of every month, so it's difficult to do. But
we're not expecting a pay increase. We're not expecting a reduction in the official cash rate, right? I don't think that's going to happen.
And look, I mean, it's been about 2 weeks since the US dropped rates. In terms of inflation cycle, we've been about 6 months behind the US. So, and this is not going to be, anything that is groundbreaking or, it's not nearly an exact science. But even if you look at it in that regard, you can probably say, all right, a couple of weeks ago, until, look a couple of weeks back plus 6 months, realistically, we're talking about after the first quarter of next year before we're likely to see any interest rate reductions.
They meet on the 4th and the 5th of November. There we go. Just fact checking that. So there we go. We should get a non-decision on the 5th of November.
Yeah, I think so.
Andrew, I reckon that wraps up the market segment for today. To our viewers and our listeners, thank you for your time and attention. I hope you got a fair bit out of it. Don't forget to like and subscribe and share with family members, and we'll catch you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.